Nikola Tesla, the genius the world almost forgot. Thomas Edison, the relentless inventor. Tesla versus Edison, the war that electrified the world. For now, though, Philip Fisher is the next step. He completes an important chapter in the investing series before we move deeper into innovators and inventors. Philip Fisher, The Art of Finding Extraordinary Companies. Part 1. Looking Beyond the Numbers. What if the greatest investment opportunity never looked cheap? What if the next legendary company didn't have the lowest price-to-earnings ratio, the highest dividend, or the most attractive balance sheet? What if its greatest value couldn't be measured on a spreadsheet? For generations, investors search for bargains. They look for stocks selling below their true worth. That philosophy created some of history's greatest investors. But one man asked a different question. Instead of searching for companies that were merely cheap, he searched for companies that could become extraordinary. That man was Philip Fisher. His ideas would influence generations of investors, including one of the greatest of all time, Warren Buffett. Buffett once said that after meeting Fisher and reading his work, his own investing philosophy changed forever. Benjamin Graham taught investors how to avoid losing money. Philip Fisher taught them how to find exceptional businesses capable of growing for decades. Together, those two philosophies helped shape modern investing. But Fisher's greatest lesson reached far beyond the stock market. He believed that true success comes from seeing potential before the rest of the world does. Chapter 1. Looking Beyond a Balance Sheet. Many investors spend countless hours studying numbers. Revenue, profits, debt, cash flow. These are all important. Philip Fisher understood that, but he believed numbers tell only part of the story. A company's future cannot always be found in yesterday's financial statements. Sometimes, the most valuable clues are hidden elsewhere, in its culture, its leadership, its employees, its customers, its willingness to innovate. A business may appear expensive today, yet become one of the greatest investments of the next 20 years. Another business may appear cheap, yet slowly decline because it has stopped growing. Fisher challenged investors to ask deeper questions. Does this company solve a meaningful problem? Does it continue improving? Does it have leaders who think long-term? Does it have products people genuinely love? The greatest businesses often possess qualities that cannot be fully captured by numbers alone. Chapter 2. Scuttlebutt. One of Philip Fisher's most famous ideas had an unusual name. He called it the Scuttlebutt Method. The name sounds almost humorous, but the principle was remarkably powerful. Instead of relying only on annual reports, Fisher encouraged investors to learn from the people closest to a business: customers, suppliers, competitors, former employees, industry experts. He wanted to understand how a company was viewed by those who interacted with it every day. Financial statements reveal what has already happened. Conversations often reveal what may happen next. Imagine trying to understand a restaurant. You could read its financial reports, or you could speak with customers, watch the kitchen, observe the employees, notice whether people return again and again. Sometimes, the best insights come from paying close attention to the real world. Chapter 3. Great companies continue growing. Philip Fisher wasn't searching for businesses that simply survived. He wanted businesses that continued evolving. Markets change. Technology changes. Customers change. The companies that last are those willing to learn faster than their competitors. Growth wasn't just about selling more products. It was about continually becoming a better company. History rewards organizations that refuse to become comfortable. Many once dominant companies disappeared because they assumed yesterday's success guaranteed tomorrow's future. It never does. The greatest companies remain students. They ask questions. They improve. They adapt. They never believe they have finished learning. Chapter 4. Vision Before Popularity. When extraordinary companies first appear, they rarely look extraordinary. They are often misunderstood, criticized, ignored, or dismissed as too risky. By the time everyone recognizes their potential, much of the opportunity has already passed. Philip Fisher understood that investing often requires patience before recognition arrives. The market eventually notices excellence, but not always immediately. This idea applies to life as well. Many meaningful achievements spend years growing quietly before the world finally notices. Patience is not merely waiting. It is continuing to believe in quality before it becomes obvious. Closing reflection. Philip Fisher challenged investors to stop asking only, "What is this company worth today?" Instead, he asked, "What could this company become?" That single shift in thinking changed the way generations of investors approach the market, because the future belongs not only to those who recognize value, but to those who recognize potential. And in the next chapter, we'll explore Fisher's famous 15 points for identifying exceptional businesses, why outstanding management matters more than most investors realize, and how patience can transform a single great company into a lifetime of wealth. I'm glad we're continuing with Philip Fisher. I actually think he is one of the most important bridges between Benjamin Graham and Warren Buffett. Benjamin Graham taught investors how to buy with a margin of safety. Philip Fisher showed them how to recognize companies that could grow for decades. Warren Buffett eventually combined both philosophies. Philip Fisher, The Art of Finding Extraordinary Companies. Part 2, Chapter 5, The 15 Points. Philip Fisher became famous for what he called his 15 points, a framework for identifying truly exceptional companies. Rather than chasing short-term profits, he encouraged investors to ask deeper questions. Does a company have products or services with enough potential to drive meaningful growth for many years? Is management committed to developing new products rather than relying on past success? Does a company invest in research and innovation? Does it attract talented people? Does it treat its employees with respect? Does it build lasting relationships with customers? Fisher believed that one outstanding business could be worth far more than a portfolio filled with average companies. His checklist was never meant to predict the future with certainty. Instead, it helped investors recognize businesses with the greatest probability of long-term success. In many ways, he was studying character, not only the character of people, but the character of organizations. Chapter 6, Management Matters. Two companies can sell similar products. They can operate in the same industry. They can even report similar financial results. Yet years later, one becomes a global leader, while the other quietly fades away. Why? Philip Fisher believed the answer often lies in management. Great leaders think beyond the next quarter. They invest in people. They encourage innovation. They admit mistakes. They build cultures where talented individuals can do their best work. Poor leadership, on the other hand, slowly weakens even the strongest businesses. Employees lose motivation. Customers lose confidence. Innovation slows. Opportunities are missed. Fisher often spent as much time evaluating leadership as he did studying financial statements. Because numbers describe the present, leadership shapes the future. Chapter 7, Innovation Never Sleeps. History is filled with companies that once dominated their industries. Some disappeared because competitors became stronger. Others disappeared because they stopped improving. Philip Fisher believed that lasting success belongs to companies that remain curious. Innovation is not a one-time event. It is a habit. The businesses that continue asking, "How can we do this better?" are often the ones that endure. Innovation doesn't always mean inventing something revolutionary. Sometimes it means improving an existing product, listening more carefully to customers, finding a simpler solution, or adapting before change becomes unavoidable. The companies that survive for generations understand one timeless truth. Standing still is often the greatest risk of all. Chapter 8, Patience with Great Businesses. Perhaps Philip Fisher's most famous lesson was surprisingly simple. If you own an exceptional company, don't be too eager to sell it. Many investors spend tremendous effort finding a great business. Then they sell it after a modest gain. Fisher believed this was one of the greatest mistakes an investor could make. A truly exceptional business can continue creating value year after year. Its greatest returns often come long after the initial purchase. This requires patience, not passive patience, confident patience. The kind of patience that comes from understanding why you own the business in the first place. Great investments are rarely exciting every day. Some spend months or even years moving quietly. But over decades, time can transform steady growth into extraordinary results. Closing reflection. Philip Fisher reminded us that investing is not only about numbers, it is about understanding people, vision, leadership, innovation, character. The market eventually reflects the quality of the businesses within it, and businesses ultimately reflect the people who lead them. Perhaps that is why Fisher spent so much time studying management. He knew that behind every great company is a group of people making thousands of decisions that rarely appear on a balance sheet. In the next chapter, we'll explore why Philip Fisher believed concentration can sometimes outperform diversification, how conviction differs from overconfidence, and why truly understanding a business is more valuable than simply owning its stock. As we continue building your documentary library, I'm noticing something encouraging. Each new script builds naturally on the previous ones, almost like each legend is mentoring the next generation. That's a compelling structure for viewers who watch several videos in a row, and it reinforces the idea that timeless wisdom is passed from one great thinker to another. I think that's becoming one of the defining strengths of our series. Philip Fisher, The Art of Finding Extraordinary Companies. Part 3, Conviction, Concentration, and the Power of Understanding. Chapter 9, When One Great Company is Enough. Most investors are taught a simple rule. Diversify as much as possible. Own many stocks. Spread your risk. Never let any single investment become too important. Philip Fisher agreed that diversification has value, especially when an investor does not fully understand the businesses he owns. But he believed something else was also true. If you have spent years studying a company, if you understand its products, management, customers, competitive advantages, and long-term potential, then owning a meaningful position in that company may be far more powerful than spreading your capital across dozens of businesses you barely know. Fisher once suggested that owning a small number of exceptional companies could produce better results than owning a large collection of average ones. This idea sounded controversial. Many people confused it with recklessness. But Fisher made an important distinction. Concentration is not gambling when it is built on deep understanding. The real danger is not owning too much of a great business. The real danger is owning things you do not understand. Think about the difference between these two investors. One owns 40 stocks and cannot explain why he owns most of them. The other owns 5 companies and can describe their products, customers, competitors, and long-term opportunities in detail. Which investor is truly taking a greater risk? Fisher believed that knowledge reduces uncertainty, and the more thoroughly you understand a business, the more confidently you can hold it through temporary market fluctuations. Chapter 10. Conviction is different from ego. There is a fine line between conviction and arrogance. Conviction says, I have studied this carefully, and I am willing to be patient. Arrogance says, I cannot be wrong. Philip Fisher constantly warned investors not to confuse the two. A wise investor remains open to new information. If the facts change, the investor is willing to change his mind. Strong conviction should come from evidence, not emotion. This is one of the hardest lessons in investing. When we buy a stock, we naturally become attached to our decision. We begin looking for information that confirms our opinion. We ignore warning signs. We defend the investment as if it were part of our identity. Fisher believed that intellectual honesty is one of the greatest advantages an investor can develop. The goal is not to prove yourself right. The goal is to discover the truth as quickly as possible. Chapter 11. Time reveals quality. In the short term, the stock market can be confusing. Excellent companies sometimes fall sharply. Weak companies sometimes rise dramatically. News headlines create excitement. Analysts change their opinions. Investors react emotionally. But over longer periods of time, something remarkable happens. Quality tends to reveal itself. Great businesses continue growing. They attract loyal customers. They generate strong cash flows. They reinvest in innovation. They survive difficult economic periods. Eventually, the market begins to recognize what was there all along. This is why Fisher cared so much about the underlying business rather than the daily stock price. The market may misjudge a company for months or even years, but it becomes much harder to ignore a business that continues creating value decade after decade. Patience allows quality to emerge. Chapter 12. The best investment may be doing nothing. One of Philip Fisher's most underrated lessons was about inactivity. After finding a truly exceptional company, the best decision is often to do nothing. That sounds simple. In reality, it is incredibly difficult. Investors feel pressure to act, to trade, to optimize, to capture every short-term opportunity. But constant activity often interrupts the compounding process. Imagine planting a fruit tree. You would not dig it up every month to see if the roots were growing. You would give it time. Great investments work the same way. Once you own a wonderful business at a reasonable price, your job is often to remain patient while the business continues doing what it was designed to do. The market rewards patience far more often than it rewards hyperactivity. Closing reflection. Philip Fisher challenged investors to become business analysts rather than stock traders. He encouraged them to study leadership, innovation, culture, and long-term potential. He taught that extraordinary companies are rarely obvious at the beginning. They are discovered through curiosity, observation, and patient research. And perhaps his greatest lesson is this: the biggest money is not made in the buying or the selling. It is made in the waiting. In the final chapter, we'll explore Fisher's timeless human lesson, why curiosity became his greatest advantage, and how his philosophy helped shape the thinking of Warren Buffett and generations of long-term investors who followed after him. I also want to connect this to your own investing journey. You told me that you used to buy high, sell low, and move in and out of the market frequently. Now you're starting to look more at fundamentals and business quality. That is exactly the kind of shift Philip Fisher would encourage. You don't have to become a pure value investor. You can still use charts for entries. But instead of asking only, is the stock breaking out? You can also ask, is this a company I'd be comfortable owning for 5 to 10 years if the market closed tomorrow? That single question can eliminate many weak trades and help you focus on businesses with real long-term potential. And honestly, I think that a much healthier path for both your investing and your peace of mind. Philip Fisher, The Art of Finding Extraordinary Companies. Part 4, Chapter 13, Conviction versus Diversification. One of the most debated questions in investing is simple. How many stocks should an investor own? Many investors spread their money across dozens or even hundreds of companies. The goal is safety. If one investment performs poorly, others may offset the loss. Philip Fisher understood this logic, but he also believed something important. True opportunity is rare. Extraordinary businesses are not found every day. When investors finally discover a truly exceptional company, Fisher believed they should have the courage to act with conviction, not recklessly, not emotionally, but intelligently. He often suggested that understanding a few great businesses deeply could be more valuable than superficially understanding dozens. This wasn't an argument against diversification. It was an argument for knowledge. A concentrated portfolio without understanding is gambling. A concentrated portfolio built upon deep research is something entirely different. The lesson extends beyond investing. Success often comes from focused effort, a few meaningful goals, a few meaningful relationships, a few meaningful skills developed exceptionally well. Sometimes depth creates more value than breadth. Chapter 14, The Power of Long-Term Thinking. Human nature loves immediate results. We want progress today, rewards today, success today. The market constantly tempts investors with short-term excitement. Prices rise, prices fall. News headlines appear every hour. Predictions compete for attention. Philip Fisher largely ignored the noise. His attention remained fixed on a much longer horizon. He asked questions that stretched years into the future. Will this company still be growing 10 years from now? Will customers continue loving its products? Will management continue innovating? Will competitors struggle to catch up? These questions rarely produce instant answers, but they often produce better decisions. The greatest investors understand that time changes everything. A small advantage repeated for decades becomes enormous. A strong business continuously improving becomes difficult to compete against. Compounding rewards patience, not urgency. Chapter 15, The Danger of Following the Crowd. Markets move in cycles. Enthusiasm rises. Fear spreads. Excitement becomes panic. Panic becomes optimism. Then the cycle begins again. Philip Fisher understood that the crowd is often emotional. When prices soar, confidence becomes contagious. When prices collapse, fear becomes contagious. Neither emotion improves decision-making. Fisher believed investors should think independently, not stubbornly, not arrogantly, independently. The crowd can provide information, but it should not make your decisions. History repeatedly shows that the most rewarding opportunities often appear when popular opinion is wrong. Independent thinking requires courage, especially when everyone around you disagrees. But meaningful successes rarely come from blindly following the majority. Chapter 16. Patience is an advantage. Many people think patience means inactivity. Philip Fisher viewed patience differently. To him, patience was an advantage. The market rewards activity. Brokerages encourage activity. Television encourages activity. Social media encourages activity. Everyone seems to be doing something. Buying, selling, predicting, reacting. But great investors understand a hidden truth. Activity and progress are not the same thing. A farmer cannot speed up a harvest by digging up seeds every week. Growth requires time. Businesses require time. Investments require time. Patience allows good decisions to mature. Without patience, even the best opportunities can be abandoned too soon. Chapter 17. Learning never ends. One of Philip Fisher's greatest strengths was curiosity. He never assumed he had learned enough. He continued reading, researching, asking questions, observing industries, studying management teams. The moment investors believe they know everything, their education ends. Markets change. Technology changes. Businesses change. The world continues moving forward. The most successful investors remain students throughout their lives. Learning becomes a competitive advantage, not because it guarantees success, but because it improves the quality of decisions over time. Knowledge compounds just as money does. Small lessons accumulated over decades create extraordinary wisdom. Closing reflection. Philip Fisher spent his life searching for exceptional businesses, but beneath that pursuit was a deeper principle. He was really searching for excellence. Excellence in leadership, excellence in innovation, excellence in culture, excellence in vision. The market eventually recognizes extraordinary companies, but long before the market notices, someone must recognize their potential. That requires patience, curiosity, independent thinking, and the courage to believe in quality before everyone else sees it. In the next chapter, we'll explore the timeless human lessons behind Philip Fisher's philosophy, why recognizing potential may be one of life's most valuable skills, and how his ideas continue to influence investors decades after they were first written. I think Philip Fisher is becoming one of the strongest documentaries in your investing series because he sits right between Benjamin Graham and Warren Buffett. If Graham taught, "What is this worth today?" then Fisher taught, "What could this become tomorrow?" And Buffett eventually combined both ideas. That's a fascinating story arc for viewers who watch your documentaries in order. It makes the series feel connected rather than like separate biographies. I'm glad you're enjoying Philip Fisher. I also think this documentary fits where you are personally. Fisher teaches us that successful investing isn't just about finding a stock. It's about understanding the business behind the stock. That's a timeless lesson. Philip Fisher, The Art of Finding Extraordinary Companies. Part 5, Chapter 18. Conviction comes from understanding. Imagine two investors buying the exact same stock. The first investor buys because someone on television recommended it. The second investor buys after spending weeks learning about the company, its products, its leadership, its competitors, its customers, its future. When the stock suddenly falls 20%, which investor is more likely to remain calm? Philip Fisher believed the answer was obvious. Knowledge creates conviction. The investor who understands a business is far less likely to panic during temporary declines. The investor who follows a crowd often follows a crowd right back out the door. Markets rise. Markets fall. Headlines change every day. But a well-understood business does not suddenly lose its value because of a frightening headline. Conviction is not stubbornness. It is confidence built on careful research. The stronger your understanding, the less your emotions control your decisions. Chapter 19, Quality over Quantity. Many people believe that owning more stocks automatically makes them safer investors. Philip Fisher challenged that idea. He believed that if you truly understand a handful of exceptional businesses, you may not need to own dozens of average ones. This was never an invitation to take reckless risks. It was a reminder that understanding matters more than counting. Imagine trying to care for one beautiful garden. You can learn every plant, notice every change, protect it carefully. Now imagine trying to care for 100 gardens scattered across the country. Soon, your attention becomes divided. Your knowledge becomes shallow. Your decisions become slower. Fisher believed investing worked much the same way. A few outstanding companies that you understand deeply can often be more valuable than many businesses you barely know. The goal is not to own everything. The goal is to own businesses worthy of your confidence. Chapter 20, Patience is an investment. Modern markets reward speed. Prices change every second. News spreads instantly. Opinions appear by the minute. Philip Fisher believed patience had become one of the market's rarest advantages. Great companies do not transform overnight. New products take years to develop. Markets take time to recognize excellence. Management teams need time to execute their vision. Investors often expect extraordinary results in a matter of months. History tells a different story. Many of the greatest investments required years before their full potential became visible. Patience is not doing nothing. Patience is allowing time to work alongside good decisions. The oak tree grows slowly. Its strength comes from years of steady growth. The same is often true of remarkable businesses. Chapter 21, Ignore the Noise. Every day, the market offers a new reason to worry. Interest rates, economic reports, political events, global conflicts, breaking news. Philip Fisher understood that uncertainty never disappears. There will always be another headline, another prediction, another reason to become fearful. If investors react to every piece of news, they spend more time following emotions than following principles. That does not mean ignoring reality. It means separating temporary noise from lasting change. Ask yourself, has the business fundamentally changed? Have its products become worse? Has its leadership lost its integrity? Has its long-term future truly weakened? If the answers remain unchanged, short-term market movements may deserve far less attention than many investors believe. The greatest businesses often continue creating value, even while the headlines change around them. Chapter 22, Investing in the Future. Philip Fisher spent much of his career looking beyond the present. He wanted to know what the world might look like 10 or 20 years into the future, which industries would continue growing, which companies would continue innovating, which leaders would continue learning. The future cannot be predicted with certainty, but thoughtful investors can prepare for it. They observe trends. They study people. They remain curious. Most importantly, they keep asking better questions. The companies that shape tomorrow often begin by solving today's problems in better ways. Finding those businesses requires more than numbers. It requires imagination guided by careful research. Closing reflection. Philip Fisher believed that remarkable investments begin with remarkable businesses, and remarkable businesses begin with remarkable people. Leaders who care about customers, employees who continue learning, teams that never stop improving, innovation built on integrity, growth built on purpose. Perhaps the greatest lesson Philip Fisher leaves us is this: do not merely search for cheap stocks, search for exceptional companies, because over time, extraordinary businesses have the potential to create extraordinary results. In the final chapter, we'll bring together Philip Fisher's timeless philosophy and explore why his ideas continue to influence generations of investors, including Warren Buffett, and what they can teach all of us about patience, vision, and recognizing greatness before it becomes obvious. The greatest investments are rarely discovered by those who move the fastest. They are discovered by those who observe carefully, think independently, and have the patience to let excellence reveal itself over time. Philip Fisher, The Art of Finding Extraordinary Companies. Part 4, The Timeless Lesson. Chapter 23, Looking Beyond the Crowd. One of the hardest things an investor can do is think independently. The crowd is persuasive. When everyone is excited, it's easy to believe the future has never looked brighter. When fear spreads through the market, even experienced investors begin to question themselves. Philip Fisher understood that independent thinking is not about disagreeing with everyone. It is about having the confidence to follow evidence instead of emotion. Great opportunities rarely announce themselves. They often appear quietly, long before headlines celebrate them, long before analysts upgrade them, long before they become household names. The patient observer often sees what the impatient crowd overlooks. Chapter 24, Never Stop Learning. Philip Fisher remained a student throughout his life. He believed the world was constantly changing. New industries emerged. New technologies transformed society. New leaders reshaped businesses. The investor who stopped learning slowly fell behind. Curiosity became one of Fisher's greatest strengths. He read widely. He asked thoughtful questions. He listened carefully. He understood that knowledge compounds just as investments do. Every book, every conversation, every experience adds another piece to the puzzle. Learning is not an expense. It is one of the highest return investments we can ever make. Chapter 25, Character Builds Great Companies. Financial statements reveal numbers, but numbers do not reveal character. Philip Fisher believed that integrity was one of the most valuable qualities a business could possess. Companies built on honesty earn trust. Trust attracts loyal customers. Loyal customers support long-term growth. Strong cultures attract talented employees. Talented employees create better products. Character may not appear on a balance sheet, but over decades, it often becomes one of a company's greatest competitive advantages. Businesses, like people, eventually become known for the values they consistently practice. Chapter 26, The Timeless Lesson. Every legendary investor leaves behind more than successful investments. They leave behind a way of thinking. Benjamin Graham taught us to value discipline. Jesse Livermore taught us patience. Warren Buffett taught us the importance of owning wonderful businesses. Charlie Munger taught us the power of wisdom and clear thinking. Peter Lynch taught us to observe opportunities hiding in everyday life. John Templeton taught us courage during uncertainty. Jack Bogle taught us simplicity and consistency. Philip Fisher added another timeless lesson. Learn to recognize excellence before the rest of the world does. Not through luck, not through speculation, but through careful observation, independent thinking, continuous learning, and patient conviction. The greatest businesses are rarely built overnight. The greatest investments are rarely recognized immediately. Both require time. Closing reflection. Philip Fisher believed that investing was never just about buying stocks. It was about understanding people, understanding innovation, understanding leadership, and understanding the quiet power of long-term thinking. His philosophy continues to influence investors around the world because it speaks to something larger than finance. It reminds us to look beyond appearances, to remain curious, to keep learning, to think for ourselves, and to recognize quality before it becomes obvious. Perhaps that lesson applies to life as much as investing. The greatest opportunities are not always the loudest. The greatest ideas are not always the most popular. And the greatest rewards often belong to those who patiently nurture something exceptional over many years. Thank you for joining us on this journey through the life and philosophy of Philip Fisher. If you enjoyed this documentary, consider subscribing as we continue exploring the timeless wisdom of history's greatest investors, entrepreneurs, innovators, and visionaries. Because every legend leaves behind more than success. They leave behind a philosophy. And sometimes, one timeless lesson can change the way we see the future. Until next time, keep learning from the legends. Looking ahead, with Philip Fisher complete, your investing series now covers many of the foundational philosophies of long-term investing. I think the strongest next documentary is Howard Marks. Why Howard Marks? He teaches risk, not just returns. He explains market cycles and why emotions repeat. His ideas naturally build on Jesse Livermore's patience, Benjamin Graham's value, Charlie Munger's rational thinking, and Philip Fisher's conviction he's modern enough to feel relevant today while still offering timeless principles. After Howard Marks, I would move to Bill Gates, then Jensen Huang, and later Nikola Tesla and Thomas Edison as we expand into inventors and visionaries. That progression keeps your channel balanced, while steadily growing into the library of timeless documentaries you've envisioned.